Good afternoon, everyone, and thank you all for joining us today for the sixth session of the Luxembourg Sustainable Finance Seminar Series, organized by the Faculty of Law, Economics and Finance of the University of Luxembourg and the LSFI. My name is Lorenzo Avico, and I am Deputy CEO at the Luxembourg Sustainable Finance Initiative, Luxembourg's coordinated entity of sustainable finance. For the ones who do not know us, the LSFI is a non-profit organization founded in January 2020 by the Ministry of Finance, the Ministry of Environment, Climate and Biodiversity, Luxembourg for Finance, and the High Council for Sustainable Development, with a mission to raise awareness of sustainable finance and help the financial sector transition towards increased sustainability. It is my pleasure to welcome you to this session entitled Spotlight on UNEP FI Net Zero Alliances, where we will look into the critical work being done by the Net Zero Alliances managed by UNEP FI Net Initiative. As the urgency to combat climate change continues to escalate, the role of financial institutions in steering the global economy towards a sustainable, low-carbon future has never been more vital. The UNEP Finance Initiative, through its Net Zero Alliances, is at the forefront of this transition, providing a robust foundation for financial institutions to align their portfolios with net zero emissions by 2050. As you will hear shortly in detail, the UNEP Finance Initiative is a partnership between the United Nations Environment Programme and the global financial sector. Its mission is to promote sustainable finance, recognizing the financial institutions can and must play a pivotal role in achieving sustainable development. I would like to extend a warm welcome to our speakers and panelists. Daniel Bouzas, Regional Coordinator for Europe at UNEP FI, Michael Holling, Professor of Finance and Chair for Sustainable Finance at the University of Luxembourg, Claudia Bolli, Head of Responsible Investing at Swiss Re, and Giuseppe Zammarchi, Head of ESG Metrics, Policies and Disclosure at UniCredit. They will share their expertise and experiences, highlighting the challenges and opportunities that come with committing to net zero targets. As you can see from the screen, our agenda for today will include an overview of UNEP FI Net Zero Alliances and their significance by Daniel, then a panel discussion where we will get insights from practitioners as well as on academic research on the implementation of these alliances with Claudia, Giuseppe, and Michael. And finally, a Q&A session where we will have the opportunity to engage directly with our speakers. Please post any question you might have during the event in the chat, and I will make sure to bring it up at the end. So without further ado, let's get started. Daniel, the floor is yours.
Thank you. Thank you for the introduction, Lorenzo. Very nice to be here. So as you said, well, my name is Daniel. I'm the European coordinator at UNEP FI. So that means that I lead on the actions happening in the European region. And yes, I think what I'm going to present now is a brief overview of the net zero work that we undertake at UNEP FI. And just to show how we are approaching it and what are the key issues. Of course, we undertake a bit more, but you will see in a minute. I'm going to share my screen, so just bear for a moment. And there we go. Let me know if you can see it. Perfect. So UNEP FI, as you introduced very briefly, Lorenzo, it's a partnership between the United Nations and the global finance sector, more specifically UNEP, so the United Nations Environment Programme. And we work in partnership with more than 500 banks, insurers, and investors to really understand how they can integrate better sustainability at the core of their financing, their key actions and strategies. And we develop for that guiding norms to measuring sustainable finance in that regard. We have created the Principle for Responsible Investment, which is now a separate organization, but sister organization. And still within the full remit of UNEP FI, we have the Principle for Responsible Banking, Principle for Sustainable Insurance. That are the overarching approaches on the industry side. And we co-create practical research tools and peer exchange forums to really help financial institutions deliver on their sustainable journey for the stakeholders, clients, customers, and all of the rest of relevant pieces of the puzzle. So this is how our membership looks like globally. As you can see, in Europe is the main chunk with more than 220 members, with banks being also the main part of the membership, and this is reflected as well across the regions. You can see that, of course, Latin America, Asia are growing quite rapidly, as well as Africa and North America, and we represent around 170 trillion US dollars in assets represented. So showing that it's not only about the number, but the numbers that the institutions manage. And in terms of our alignment with the SDGs and what do we mean by sustainability, because in many cases, when we talk about sustainable finance, a lot of the thinking, especially in Europe and in developed countries, is more about climate. But this is not the only part of sustainability. This also includes nature, SDGs and impact, pollution, circular economy, social human rights, and policy and regulation as a cross-cutting, overarching approach on how to also mainstream this with the help of the public sector. But of course, when we talk about net zero, we focus mainly on the first point, that is climate change, and the transition to low carbon economies and let's say the commitment of Paris Agreement to 1.5 degrees. So this is the overarching, let's say, approach. As we said before, principle for responsible banking, principle for sustainable insurance, but we also have created the PRI and the Sustainable Stock Exchanges Initiative, which now are, of course, let's say, working on their own, but very, very closely connected to us. And working towards net zero, what we have is 3 alliances. There's the Net Zero Asset Owner Alliance, Banking Alliance, and Export Credit Agencies Alliance. So the Net Zero Asset Owner Alliance was the first one launched in 2019 in collaboration with PRI, has more than 80 members and more than 10 trillion US dollars in assets managed. The Banking Alliance was launched in 2021, more than 140 members. This is the most numerous of the alliances that we have, and representing 40% of the global banking industry. Of course, today in this webinar, we have representatives of both of these alliances that are going to, of course, provide more insights on the inner workings of how they work. Then we have the Net Zero Export Credit Agencies Alliance. That is the newest, launched in 2023 during COP, with 5 members and 3 affiliates. It's a bit, let's say, smaller, but it's growing. And of course, the actors that are participating are a bit different because they are, of course, in many cases, public supported entities. And they support 120 billion international trade in 2020, of course, with guarantees and other products. And then we also have a new approach as a multi-stakeholder engagement, that is the Forum for Insurance Transition to Net Zero, launched in 2024, representing 46 organizations, that is also looking into the insurance aspects of net zero transition. So I will start with the largest, that is the Net Zero Banking Alliance. That is an industry-led and UN convened. This is quite important to understand because all of these alliances are UN convened, and they all, let's say, the alliances on net zero, they participate also of GFANZ, that is the umbrella organization and the race to net zero that agglutinates. So I say it brings together all of the finance-related net zero alliances that have committed to this. It's not only ours, but for example, also the Net Zero Asset Manager initiative that is also participating in GFANZ, but it's not managed through, let's say, the UNEP FI, the UN umbrella. So the Net Zero Banking Alliance, a group of global banks committed to ambitious climate action, more than 140 banks in more than 40 countries, representing 74 trillion of US dollars in total assets, which translates to 41% of global banking assets. So this means that, of course, the numbers are big, but the numbers they manage are also quite large and representative of the economy. And the key requirement from the alliance is to really, for the banks to set targets to decarbonize their portfolios using 1.5 degree scenarios. So that means that they need to be ambitious and aligned with the best science. And we cover a large amount of operations from these institutions. The commitment that the banks make is underpinned by the guidelines for climate target setting for banks. I'm going to present here now the version 2, which is the updated version from 2021. Now this is the latest, and you can see really that the 4 core elements remain. If you have seen the previous one, they are a bit more, let's say, on target. And banks, the first element is banks should individually and independently set and publicly disclose long-term and intermediate targets to support meeting a net zero by 2050 greenhouse gas emission goal. This is important because it's not only about the 2050 target, but also the work in between. Second, the banks need to establish the emission baseline to understand, okay, where do we depart from and where do we go towards the net zero approach, and annually measure and report the emissions profile that they have. Third, as I said before, also especially already starting with the 1.5 degree element, that they need to use science-based decarbonization scenarios to set both the long-term and the intermediate targets. As we said, it's not only the end goal, but also the way to get there. And regularly review the targets to ensure consistency with the current climate science. I mean, we're agnostic, let's say, to some extent in the approaches, but of course the approaches need to be aligned with the science and with the most relevant data that is available. So this is how it works a bit more concretely. So setting this 2050 target needs also to be predated by a 2030 interim target or sooner for all the on-balance sheet lending and investing. Off-balance sheet guidelines are under development, and the main issue here is like banks will need to set the targets for 9 key economic sectors, starting with those, let's say for the 18 months, for the sectors that are where they can have the highest impact. So those that are they're most exposed, or that they have better connections with the clients in order to make the distinction. And you can see the sectors there. I'm not going to stop too much, but you can imagine they're the ones that contribute the most to emissions. And the targets need to be science-based, as we said, with no or low overshoot scenarios. So the emissions cannot peak fully too much before decreasing. I mean, it cannot be until 2049 increasing and then 2050 decreasing. No, it needs to be lower. Report annually on the progress. This is what we discussed before, and also take a robust approach to the offsets. This is quite relevant. And what does this net zero commitment mean? Well, it needs to be systemic, holistic, science-based, transparent, and immediate. I'm not going to stop too much, just to underpin that systemic, because it needs to be at the core of the change that the banks need to undertake, and for that is also holistic, because it needs to encompass all of the elements of the portfolio across the sector, geographies, and the full approach that the bank has. I mean, if a bank is based in Europe and has a large exposures in Africa, Asia, Latin America, that also needs to be accounted. Science-based, as we said, the latest science, transparent, the disclosures need to be there. In Europe, we also have seen a lot of the mandatory disclosures that are in some cases also pushing the institutions to go beyond, and immediate, to take the immediate and concrete action to do this. The timeline, this is it. I mean, as we said, the interim targets, the first ones at the 18-month period, are those that need to be, well, for the sectors that are the most, let's say, the ones that are prioritized, that they represent the most exposures for a bank. Then the transition plan is to happen at the middle of this year 3 with the annual report and the full set of targets by the end of the year 3. And then you continue until the 4th year and forward with the transition plan and the annual report on progress and the targets as we evolve. But you can see that the timeline is quite tight, is quite fast in comparison, for example, if you know of the initial 4-year period of the principle for responsible banking, where you can also commit to climate, but this would be the accelerator for those principles on the climate commitment. Okay. Regarding the Net Zero Asset Owner Alliance, now we turn our view to asset owners. This is a member-led initiative of institutional investors, in this case, committing to transition their investment portfolios to net zero 1.5 by 2050. 9 members with more than 9.5 trillion assets under management, and they are the first, let's say, in the finance industry to set these kind of targets, which include CO2 reduction ranges for 2025 and 2030. This is a bit different from, let's say, the banks, because it's about the lending and investment portfolios. This is more about, okay, how are we going to make sure that our portfolios are within the ranges in the investments that we're making? And the key process that I need to undertake is to make the commitment, boost the efficacy of the initiatives, and report on progress. So quite similar, is just that given that it's been running for longer, it includes extra elements that can be done beyond the portfolios and the other elements that are included. So how should and why the asset owners align with net zero? First of all is the fiduciary duty. This already, let's say, translates much of the work that has happened since the 2005 Freshfields report that was updated with the other Freshfield reports that were published quite recently on the, let's say, the key reasons why investors need to look at this. And of course, this is to reduce risks. If you're able to integrate all of these considerations on climate, first of all, into your operations, you are going to reduce the risks. For insurance companies, this also is reflected on the underwriting side of the balance sheet, and additional return expectations in the future. There's also more client requests and more shareholder requests for doing this. More clients, especially, you can see, and I can assume also in the Luxembourg market with the Article 8, Article 9 products, everybody is really, trying to understand how to meet the request. And then general social responsibility for the society, future generations, and the planet, and the rest of the elements. So these strategies are quite concrete. And the commitment, so this was the why, and this is how and what they need to do. The commitment document needs to, what the asset owners need to do is to commit to transition investment portfolios to net zero greenhouse gas emissions by 2050, 1.5 degrees. They fully endorse, understand that they need to undertake this commitment holistically. This goes back to what we were discussing for the Net Zero Banking Alliance, and showcase how these greenhouse gas reductions are having key outcomes in the real economy. Because as we say, the economy, the transition of financial institutions is the transition of the real economy that they finance. And I think that is a critical piece to take away. And finally, just to understand that this all needs to be done with science, the best science available also for the specific sectors that are being decarbonized, and advocating as well these key actions through policies and through other means that are not only related to the key actions. So it goes beyond the only work internally as others do. And the 6 minimum requirements on the how, this would be setting intermediate individual targets within 12 months of joining, as well as key other elements from the protocol, publishing these intermediate targets, disclosing publicly annually as well on the meeting of the targets, reporting as well the progress toward the intermediate targets via the internal alliance reporting. So we have, let's say, this dual approach in that regard. Pay membership fees, of course, and then the position considering adopt to publish the assessment of policy or approaches in front of the alliance position on what is going to be happening in the way forward. But I know, we're a bit pressed for time. I don't want to stop too much, and I will let, of course, Claudia to fully explain. And then finally, the last element would be the Net Zero Export Credit Agencies Alliance. That would be, the newest one, a bit more of a niche market player that, of course, they provide guarantees and they provide, letters of credit and other types of products that are very specific, especially with banks. And they provide a lot of financing, indirect financing in this case, payment risk protection, and support the governments and the economies to transition. Of course, in many cases, these institutions need to be following national guidelines, what needs to be the specific promotion. And of course, this also orientates how they can work towards specific sustainability goals. But we see in Europe and beyond, and especially in the common approaches of the OECD, that sustainability has been more and more relevant for these institutions. Being, of course, as we said in the beginning, I didn't cover that 80 to 90% of international trade relies on export credit agencies and export-import banks. So what the alliance tries to do, well, as the others, net zero by 2050, a commitment, and trying to deliver that 2050 or sooner, bringing together export credit agencies and export-import institutions committed to deliver on net zero, focus on the implementation of the commitments, to really deliver these credible methodologies. We don't have a methodology as such as we have in the Banking Alliance or in the Net Zero Alliance, but it's part of the work. For that, developing this consensus on net zero approaches is key, and creating more access for other institutions to also join. And benefiting from the support of GFANZ, we are also collaborating here with the Knowledge Hub at Oxford. So it's a broader collaboration as well, but still it's hosted with UNEP FI and under GFANZ. And it was launched officially COP28 in Dubai, and you can see a bit more of the details here. It's the first one for public financial institutions in terms of the alliances, which is a big step, but also showcases the commitment from this side. Connecting trade finance to the real economy, 8 funding members, 7 countries, so quite broad. But then we have also the other supporting, let's say, associate institutions, and there's flexible membership options in that regard. And the commitment is to align portfolios with Net Zero 1.5 and discontinue the support of unabated fossil fuel energy by the end of 2024. So the second one is quite clear, it's quite fast. But then for the first one, we need still to create the key materials to go beyond. And that's it. So, I mean, I will finish here. I don't want to take much more time. I hope I complied. And just to say that happy to take any questions as well, and very much looking forward to hearing the Net Zero Banking Alliance and Asset Owner Alliance members present here discuss further in the panel.
Thank you very much, Daniel. Thank you very much for shedding light on these two alliances and for describing the ambitious plans set up by the members of the alliances themselves. So let's move on to the panel discussion now with our guests. Claudia Bolli, Head of Responsible Investing at Swiss Re, Michael Holling, Professor of Finance and Chair for Sustainable Finance at the University of Luxembourg, and Giuseppe Zammarchi, Head of ESG Metrics, Policies and Disclosures at UniCredit. So first question for Claudia and Giuseppe. What has been your journey to joining an UNEP FI alliance, from internal process to the implementation, best practices and challenges?
Claudia, will you go first? Yeah.
I'm happy to do so. Yes, thank you very much. Probably let me quickly go one step back. So actually, I work for a reinsurance company. So that means we insure nature catastrophes. And asset management, as described, right, the Net Zero Asset Owner Alliance covers actually the asset management area. So asset management mandate is to invest the premiums generated through these underwriting activities an insurance company has, and invest these premiums into assets whose cash flows have to match durations and currencies of the reinsurance liabilities to ensure the company can always pay out the claims. So that's the mandate of an asset management within a reinsurance organization. So what does that actually mean when we on one side insure the nature catastrophes, but then also take that money and invest it and need to make sure we need to bring it back to the client when there is a claim? It means that we are therefore exposed to climate change on both sides of the balance sheet, and therefore have a clear reason to actively mitigate this risk consistently on both sides. So that is the driver why we care not only on the underwriting side, but also on the asset management side about climate change. So when the Asset Owner Alliance was founded in 2019, the asset owners themselves were at the very early stages with regard to reporting climate information, while the roadmaps to achieve net zero by 2050 were a very theoretical concept, right? So there was this ambition level defined to achieve net zero by 2050, but the question was very much on the how, because we were just starting to report the data. So the idea of the Asset Owner Alliance was actually to create a document that shows the various approaches and metrics, but also the pros and cons, because at that time it was also a very, very segregated market with regard to reporting. That this document should support then each and every reader to set its own targets to transition to net zero by 2050 individually, right? So everybody has to go that journey on its own. So this was actually the hour of birth for what we call within the Asset Owner Alliance the target setting protocol. So that target setting protocol, now the fourth version exists. They are all available when you go to the Net Zero Asset Owner Alliance homepage. So in case you're interested to read that, what is in there, please feel free to go. The target setting protocol composes of the four areas. Lorenzo before mentioned, right, within the commitments a member to the Net Zero Asset Owner Alliance make is to set targets in 3 out of 4 areas. So these 4 areas are covered in the target setting protocol. And these 4 areas are sub-portfolio targets, sector targets, climate solution investment targets, and engagement targets. And these 4 components actually are the tools that can help you to set the ambition level, but also get the actions how to achieve that ambition level to be set. So that was a little bit the journey we went through, but also with regard to best practices and what is currently in the market. On the other side, what we also see on a very near-term basis is, of course, that all the regulators have come up with requests to develop climate transition plans, which actually documents as the target setting protocol can help to develop that. So for the time being, I stop here and hope that already gives certain insights on what has been done by the Net Zero Asset Owner Alliance.
Thank you very much, Claudia. Giuseppe.
Thank you, Lorenzo. Thank you, Claudia and Daniel. First of all, thank you very much for having me here and present a bank's perspective on this. We joined the Net Zero Banking Alliance a few months after it was launched. So it was launched, as Daniel said, April 2021. We decided to join in October, because we had long internal discussions between the management and the board in order to decide actually what we wanted to do. We have been taking ESG topics and in general sustainability topics quite seriously and for quite a long time, because the first social and environmental report of our group dates back to year 2000. So we wanted to really do the right thing and make the right step. Because at the end of the day, for us, taking a commitment like this and setting targets means also, engaging in a journey that can have relevant reputational consequences if we don't then meet the targets. So the first, let's say, obstacle to overcome was the full alignment of the board and the top management. And starting from there, I would say things became a bit easier, in the sense that we needed to involve all the relevant functions and people in the company. We are an international group, meaning that we have our headquarters in Italy, but we also have legal entities in different countries around Europe. And all these legal entities have their own delegated powers, targets, budgets, lending portfolios, and so on and so forth. What we have always put in place at the group is to have a central functions steering the group, for example, with policies, with commitments, and with decisions. But then, of course, the legal entities of the group must be empowered in order to reach them and in order to act according to them. So for us, involving risk management functions, business functions, planning, in order to then split the targets that we always set at group level, but must be then reached thanks to the work of all the companies, was a little bit of the name of the game. I would say that it was very important for us to have top management support. This is clearly helping because when you set the direction, it becomes then easier to work all together in that direction. In the past, it was not always like this because I can remember some of the policies we worked with, for example, the coal one, where we had long discussions internally among business and risk management functions, because the two, let's say, objectives was not really going in the same direction. In the case of Net Zero, instead, I would say we learned from the experience of the past, and we've been acting together since the very beginning. Then, of course, challenges in setting targets and preparing transition plans also need to take into account the coherence of all frameworks, because the net zero targets work well if they are aligned and coherent with the principles of the policies, for example, that we have on the sensitive sectors. And here we're talking about oil and gas, for example, we're talking about power, we're talking about coal, we're talking about aviation or automotive. So that work of putting all the things together and make sure we are coherent was something that took a little bit of our time, also because it is basically changing, totally changing the way in which credit underwriting works. And you know that credit underwriting and lending policies are the essential work of a bank. They have been there like these, I would say, forever, for a long, long time at least. Now they have to take also into account the clustering of the different customers according to the credibility of their transition plans, according to the existence, even in some cases, of a transition plan. So now what we are doing is completely changing the way in the bank will work, in which the bank will work for the future. So that is still an ongoing work. Credit committees will have to take into account also the net zero stance on the customers, and that is clearly requiring also a change of culture, which is the last challenge I want to mention, because that is an essential channel. Without that, we don't go anywhere. So I'll stop here as well and maybe leave some room for further discussion later on.
Thanks a lot, Giuseppe. So for both of you, Giuseppe and Claudia, can you tell us about your company's transition plan and how the UNEP FI Alliance you are part of has helped set an actionable, near-term, science-based transition plan? Ladies first.
Yes, thank you very much. Happy to do so. Let me build probably a little bit on what I just said with regard to the target setting protocol from the AOA. So AOA is the short term of Asset Owner Alliance. So, I mean, this was for us a helpful document to set meaningful targets, and also within the AOA, there is this statement, or how should I say, this ambition level to set every 5-year targets. You need to release them publicly. You need to report about them publicly. That is kind of a process, right? So we were one of the founders of the Asset Owner Alliance in 2019. We have then set targets based on the target setting protocol, or taking that into account. And actually it happens the following way. I mentioned beforehand the 4 areas where you need to take 3 out of it. So we started with the sub-portfolio target, where we define the starting point. So from which date on do we start measuring the emission? So while we have reported already since a long time on TCFD, for the target setting, we had to set a date, which was 2018. And that was the base year. And then we also defined, based on where we were at that point with regard to carbon intensities, what is a reasonable reduction until 2025, because that is considered a 5-year period for target setting, because it was initiated in 2019, first target setting protocol in 2020, 5-year period 2025. Nevertheless, you could still set at that point earlier base years, which we did. So that was why we have base year 2018. Having said so, period till 2025, and we identified a reduction of 35% on carbon intensity. So that means we know start, we know end, we know reduction. So that target is valid for our actively managed corporate bonds and listed equity portfolio. And that means we actually invest in the real economy. So the underlying item is the real economy. And as climate change is a global challenge, and we invest in the real economy, we believe that engagement with the real economy itself is an integral part to achieve actually our transition towards net zero. So therefore, we developed an engagement framework and to discuss with indirectly with the real economy the transition. Why indirectly? Because we manage our listed equities and corporate bond portfolio via investment managers. So means we had to onboard them that they also discuss the engagement items with our investment. So how do we actually identify with whom do we need to engage first, right? And I mentioned beforehand, we know the reduction pathway, we know where we actually need to land in 2025. And we see in our portfolio who is above that landing point. So first engaging with the companies that are above our landing point support us in our own reduction, because if the underlying real economy or the investment transition themselves, their companies, our investments will by definition also transition. So that was then the second target. So this engagement framework, identifying with whom do we need to talk, is about the engagement target, the second layer. Then there is a third layer called climate solution investments. And the idea behind that target is actually, so when you ask, or when we ask the real economy to transition, right, that means for certain companies to adjust their business model, to make investments into certain, is it real estate or whatever, right? So actually there is money needed. And the climate solution investment target has been in his mind that you provide money to companies who actually want to transition. So we have set the target under that one, which is about having a green social and sustainability bond exposure of $4 billion by 2025. Additionally, we also said with regard to infrastructure, renewables, and social infrastructure, we want to allocate another 750 million during or until 2025. So meaning making capital available. Lastly, what we also have is some restrictions for certain investments. And the thinking behind that is actually, so when you have your target, when you engage with the real economy, and when you make capital available, right, you'd still see some companies might not yet have start transitioning. And if they stay where they are, but on the other side, you see now markets, regulators further advancing. That means your risk on the balance sheet increases because market moves in a certain direction. Some investments in your portfolio might stay where they are, not joining that direction. That means that risk increases. And to manage that risk, we have identified certain restrictions for investments. These goes for the time being specifically in certain areas with regard to fossil fuel. So that is actually what are our major building blocks to transition our portfolio to net zero and also actively manage the risk of assets getting stranded. So with that, happy to transition to Giuseppe.
Thank you very much, Claudia.
Thank you. So I would echo some of the important milestones that Claudio just described, because also for us, being driven by Net Zero Banking Alliance guidance, we set our transition plan that we presented at the beginning of this year, because as we said, we presented first 3 sector targets January last year. This year we added the 4th sector and we presented the transition plan. So a transition plan has some key components which are very similar to what Claudio just described. So the foundation, where we describe where we started from. So the baseline for all of our sectors that we presented last year was 2021. With targets for 2030, and starting when we get closer to 2030, we will move 5 years from 5 years until 2050. In the inaugural transition plan, we also described our engagement strategy. First of all, engagement with clients, which for us is a little bit different than what Claudia described, because we lend directly to customers without kind of intermediation like they have on the funds with fund managers. So for us, we needed to really decide how the client engagement will actually work. We defined a combination of the current present view and stance of the customers with the forward-looking view. So we basically look at where they stand now, if they are already having a high or a low environmental impact, and we combine that with the credibility of their transition plans. It means that we need to look at the transition plan of our customers in order to say if they are credible or not. If we combine these 2 things in a matrix, we will then have a clusterization or a clustering, of our customers among the laggards, the aligning customers, and the leaders. According to all these 3 clusters, some lending activities will be possible or not with every kind of customer. So if you are a leader, we can also think of increasing our exposure, because this is an exposure that going forward will bring to lower financed emissions. If you are a laggard, I see very, very difficult to continue to have a lending activity ongoing, or at least renewed on an annual basis with laggard customers. So this is something that then needs to be, of course, cascaded first to the credit committees, second to the underwriters, because business colleagues and relationship managers need to really understand very well how their customers are positioned, because in the day-to-day engagement, they must absolutely know. And for this, we have worked on an ESG platform which gives them a clear, immediate visibility on the clustering of the different customers that they have in their portfolio, in order to understand if they can propose or if they cannot propose new business, and so on and so forth. Of course, a different interpretation goes when the business is aligned to the European taxonomy. When it's green lending and so on, we can go forward independently from the clustering of customers, because that is going to have a very low impact, if not positive, on the financed emissions of the customer. Then, of course, there's engagement also with other kind of stakeholders like policymakers, regulators, international initiatives, investors. It is very important for our investors to know what we are doing on the transition financing. And then a clear part is on the implementation, where the target setting, monitoring, and risk management functions need to work very well together. First, we set targets at group level. Then internally, we manage the let's say, breakdown of these targets to the local legal entities. This entails also an alignment with the policy of incentivization for the top management and for the operative colleagues in all of the countries, because the policy we have in place also takes into account the net zero targets that we have set. Monitoring, of course, is extremely important because on a quarterly basis, we need to really understand where we stand. Are we going in the right direction? Are we respecting the risk appetite framework limits that we have set? Because otherwise, we need to escalate the decisions at the higher level up to the board level in case something is not going in the right direction. Of course, then the metrics and targets that we have set are specific of each sector. In some sectors, also due to the update of the guidelines by Net Zero Banking Alliance, we moved from some of our peers that set targets, for example, on oil and gas, on intensity. We instead were the first bank to set targets on financed emissions in terms of tons of CO2 equivalent, because at the end, this is what is really important, not the intensity, but the overall financed emissions that we have for that sector. On other sectors, for example, we are still on intensity measurement because that is the most relevant metric for the specific sector.
Thank you very much, Giuseppe. And well, on this topic, I think it would be interesting to have some words from Daniel about the interactions between the UNEP FI and the asset owners and bank members of the alliances from the UNEP FI angle, actually.
Yeah, maybe. I mean, sure. I mean, I think, of course, given that these are, UN convened and industry-led initiatives and alliances, of course, the work that needs to happen by the members themselves. Of course, I mean, that's something that we cannot substitute in any case. And as you can probably have gathered from the insights from both Claudia and Giuseppe, is that the very specific context of each of the institutions is going to shape the approaches that they are going to take to establish, let's say, the key goals and the key aspects of their engagement on the transition to net zero. And that is something that, of course, I mean, you cannot fully always compare members. Of course, if they are large institutions that share similar type of business models and they share similar type of clients, yes. But then when you go into smaller banks versus larger banks versus banks that are active in multiple jurisdictions versus one jurisdiction, it is a complete different let's say market in which you're dealing with. No, I mean, this is true for banks especially, but also for the asset owners and the rest of the institutions. And I think the best that happens from this is the learning and the different approaches that the different banks are taking to say, okay, how are you solving this problem? And it's not always this view that you can say, oh, it's the big ones helping the small ones. Well, maybe sometimes the small ones can bring interesting insights that the large institutions may not have thought about or they're not able to do because the organization is so large and they have, as Giuseppe was saying, they have ownership at the national or the branch level on what they can do. No, meanwhile, a smaller institution, I don't know, like saving banks in Norway, they may be more integrated into their community, maybe more integrated in the stakeholders that they need to deal with, not only the shareholders, and be able to react quickly to some of these elements. No, and then just to say that this, I think, is a good example of the overall approach that we have also at UNEP FI. We're trying to regionalize, in the case of our regional coordinator, but also at the institutional level to make concrete global approaches. In this case, transition to net zero, 1.5 degrees, science-based. And then you translate it into approaches that make sense for institutions. And that is an exercise that is quite complex. There is an exercise that needs to happen with the financial institutions. And that is also the difference that we bring as UNEP FI, and here just to say that if you want to join, don't hesitate. I think there's interest from our side as well to expand a bit more, to have these insights, and to have these key approaches, and especially when we're looking now in Europe, a context where regulation is pushing quite much the institutions to do more, and if we were talking about transition and transition plans, now we are talking about CSRD with transition plans, CSDDD transition plans, CRD transition plans for the banks, but then SFDR as well is coming in with some key elements, taxonomy CapEx plans. And how do you bring all of that together in something that is coherent and makes sense? And then we have the GFANZ with the 4 key approaches to transition finance in this paper. So yeah, I mean, there's a lot of key elements that need to be thought through, and the institutions are in all of that conundrum in the middle. And UNEP FI, hopefully, we're trying to connect the dots, but also bring clarity on some of these approaches. And I think that is the advantage of working with institutions and across the institutions. And yeah, I mean, I think there's more learnings probably to be made on the cross-institutional learnings, like, net zero banking plus asset owner plus, and bring all of this together. But the business models are different. So, there may be institutions that are members of both, like there are members that are PRI and PRB. So yeah, I mean, probably that's something to be further explored. But at this stage, yeah, maybe that's my take. Thank you.
Thank you very much, Daniel. Let's move to academia now with Michael. Michael, I remember I remind you, is a professor of finance and chair for sustainable finance at the University of Luxembourg. Michael, as Daniel has just reminded us, alliances are industry-led initiatives. How do they complement the regulatory agenda in the transition towards net zero?
Well, thanks, Lorenzo, for having me, first of all, and then thanks, Daniel, for the presentation, and Claudia and Giuseppe for very interesting experiences in the process to engage or to sort of join this transition process. I think that's very interesting, and there's a lot of learning also going on my side. So I think from the point of view of academia and on the role of alliances, I think what Daniel just said in his last statement, I would like to second that kind of aspect. I think it's a lot about the learning, it's a lot about the collaboration that the alliances foster and establish. And of course, these kind of aspects feed or complement into the regulatory work. I think they're particular, like from my point of view, being a bit more of outside, right? Not being a member of any of these alliances, but more looking at the whole problem, more from a bird eyes and then maybe an ivory tower, but we don't like to view it like this, but from a different angle. I think the one particular aspect that I think is appealing for these alliances is the global aspect, right? Because regulation, obviously, almost by definition, is more regional and less global. And so I think alliances ensure or at least facilitate the exchange on a global scale. And I think that's a very important aspect that they add to the picture. Quickly is the coordination among sort of obviously the member institutions that are part of this transition. And of course, coordination is very important. It's important to create impact, right, and to create, so to speak, weight in the transition process. But it's also important to mitigate the traditional economic free riding problem, that if there's a lot of banks individually or financial institutions individually engaging in a potentially costly transition process, then maybe you want to ensure that many of your peers or most of your peers or most of your also competitors will maybe share and engage in the same kind of transition process to make sure that you're not the one carrying most of the burden, but then everybody else is benefiting from potentially the successful transition in the end. And of course, overall, I think from an outside point of view, it's sometimes not easy to see where most of the innovation comes from, if it's the alliances feeding into the regulation or the alliances learning from regulation. I think it's an exchange process where basically both of these players, so to speak, in this global ecosystem learn from each other. And I think alliances play an important role to inform regulation about where the industry is going. I think there's examples where alliances are certainly leading regulation, are kind of like ahead of regulation. But at the same point in time, I think it's also, once regulation is in place, alliances are a good framework for translating and helping members to implement regulation, and of course to provide feedback on the efficiency and effectiveness of regulation, to again sort of fine tune and adjust regulations in order to make sure that the sort of the targeted goals are achieved in the end. In terms of research, right, from an academic point of view, I think we can contribute a bit more on maybe the mechanisms in the transition process. Again, not from an environmental science perspective, you know, we're going to leave that to the environmental scientists, but from a finance perspective. So most of the discussion is about, you know, if you focus on capital allocation or capital reallocation, moving capital from brown assets to green assets, how much of an impact is that going to have? Is that likely going to be a strong mechanism to induce brown firms to change their business models? Or is there sort of evidence that maybe engagement is a stronger mechanism? It was already mentioned, I think both Claudia and Giuseppe brought up that, you know, that they have commitments in the engagement arena, and that's also linked to the alliances. But I think overall research would of course strongly recommend that engagement is you know, most likely a stronger mechanism to engage or to sort of to cause change than pure capital allocation. And another aspect that research brings a little bit, at least existing research brings to the table, is of course to evaluate or to start the validation process about what membership of alliances means in terms of, for example, a quality signal. Oftentimes we use in our research, especially our empirical research, we use membership of an alliance as a quality signal about the commitment of an institution with respect to, again, the net zero transition, or more broadly speaking, I mean, there's other alliances in other areas of the ESG debate. And so there, of course, you know, we bring to the table this ex post evaluation about whether signatories and members live up to their promises and their commitments. And I think overall that's a topic that maybe also from a UNEP FI's perspective or a more general perspective is an important aspect that I think comes up in many discussions, that this validation verification process, I think, is ultimately also important to make sure that that, you know, we can sort of keep the informativeness of the signal, or keep the informativeness of membership and of signing, for example, being part of such an alliance, as high as we would like it to be, and also ensure that the members really live up to their standard. Thank you, Lorenzo.
Thanks a lot, Michael. Thanks a lot. Now, coming back to Claudia and Giuseppe. So we have heard your journey, your experiences in this quite committing and tough journey. But what are the main challenges that your institutions face when implementing their commitments under the UNEP FI alliances?
So this time I'll let Giuseppe first go.
Okay. Okay, thank you, Claudia. Then I would say the first challenge would be to set a coherent framework, because at the end of the day, as I said before, coherence between commitments, strategies, targets, policies, regulation, and so on is essential. As Daniel said, there are many new regulations that in the last 3-4 years were enforced and are becoming to be acted upon in Europe. When all the frameworks were voluntary, it was basically an exercise that we decided to embark on in order to give a strong signal to markets and to stakeholders. I fully agree with what it's a clear indication of the fact that you are committed to do something and you do it seriously. Because for companies like UniCredit, like Swiss Re, and so me, if you embark on a journey, it's because you want to do it seriously. Otherwise, you don't do that. The risk that I see now and the challenge that we need to overcome is that with all this regulation, we do not transform something that was clearly coming from a strong will of companies, of managements, of board of directors into a compliance exercise, because that is the real enemy of our job. If we do things just because it's compulsory to do them, we have lost basically all of the efforts that we are doing. So keeping and maintaining the direction in a moment in which disclosure requirements or due diligence requirements are becoming so intrusive is the big challenge that we have to face. Then, of course, we needed to study a lot and to deep dive a lot some of the topics that we were dealing with. I just give you an example. For some of the sectors that we have set targets on, guidelines at international level were already there. Scenarios to compare with were already there. Oil and gas, power, automotive, more or less, there wasn't big news or things to discover when embarking in the journey. For agriculture, that's not the case. For example, agriculture is still a very important sector in terms of emissions, in terms of the countries where we are working. Agriculture is one of the top sectors in terms of our exposure in all the countries where we are. But there are some very serious challenges. The size of companies is very, very small. So getting punctual data from them is not easy at all. We can work with proxies and with estimates for the Net Zero Banking Alliance work, but for CSRD work, we cannot. So putting together all these pieces is something that we are working on, and that is taking a lot of efforts because we have to combine the data retrieval strategy with the client engagement. And the client engagement, we all know, if the client is big, it's very easy. If clients are very, very small, it becomes a bit more difficult because you don't know exactly what kind of capabilities to rerun the strategy you're facing when you're meeting the company representatives. So if it's the CFO is one thing, if it's the owner is another thing. With smaller companies, you often do not have a CFO. So also there, the part that we need to really find the right solution to tackle is the client engagement. So all these things put together, let's say, give us a bit of an overview of the challenges. For big customers in big sectors, concentrated sectors, I would say that the main challenge is to train your colleagues, my colleagues, on how they have to deal with the customer. If the customer is cluster A, B, or C, that makes a difference, but it's pretty easy. For the smaller customers, we have challenges from data retrieval to assessment of transition strategy. Most of them do not have a transition strategy. To then client engagement, because that's the challenge we said before.
Thanks a lot, Giuseppe. Claudia.
Yes, thank you very much. I would agree with quite a few points Giuseppe mentioned, but would then also say how it probably applies to our portfolio is a little bit different, right? Just what has been mentioned with regard to the data. For us, the discussion is more about, or I would say in general for us, the owner, what is a lot of discussion about is public assets or listed assets versus private assets, non-listed assets. So data availability and also data quality, especially for private assets, is super challenging. What is the background behind that? So actually, we have now more and more jurisdictions coming in with reporting requirements. You need to report your emission data and many other information. But these reporting requirements usually have mainly listed companies in scope. So therefore, they release data, many of them already since a few years. But then the private assets have not been in the scope for that in the past. So now private assets usually also, or not usually, but some of them also link back to what Giuseppe said, they are smaller organizations. So there, when you talk to them, right, it starts with, do they have the capacity? So do they have dedicated resources to actually collect the information, right? Which is, especially for the real economy, so for non-financial institutions, a super tough job. Do they have resources available to do that? And then does these resources have the knowledge to collect the data? And then or report the data. And when the data is reported, right, especially with the smaller ones who can do that independently, when you get the data, it's sometimes not in such a structured manner that it is very easy to consolidate on our side, right? And to actually report what is our exposure on a certain asset class. So that is one of the challenges which I see. Data availability, data quality is also a topic when it comes to Scope 3 data, at least still for the time being. That might change, at least in the EU, over the coming years with the CSRD reporting requirements. But so far, the data quality also there is not sufficient to structurally report. Then when we talk about Scope 3 data, it's also about methodology, right? You might have heard about these double counting considerations. So when you have when you are invested in a value chain, right? Some Scope 3 data feed into the next company of a value chain, either as a Scope 1 data or maybe even as a Scope 2 data, right? So these are further challenges. So the ambition not, or to factually accurate report what are the real emissions, right? We always don't need to forget, we talk about real emissions. It's not just a paper exercise we do here. So these are a little bit the considerations about data availability and quality. Then with regard to regulations, I also agree, right? It is a challenge when you are a global company and you report into different jurisdictions, and they have different frameworks and therefore ask you to report different metrics. So while you have content-wise the information already released, it's just the way the information is transitioned, the metric, the form is not the same as requested, which triggers additional work, while for me, it's not yet very clear how that actually adds to the actual transition, right? I mean, we don't want to, or I think none of the companies who go that journey just to report, but they really want to do that transition. And doing means action. So from my perspective, having a bigger focus on actions than on reporting over the next few years that I see as the next challenge standing in front of us. And the last challenge, which I also see, is a little bit the different aspirations in certain countries, thereby also thinking a little bit about some political about the political landscape. So that is, I see also as a challenge, right? That, let's say, one jurisdiction wants you to go more towards A, and the other jurisdiction wants you to go more towards B. I see that, by the way, also when it comes to certain frameworks, independently of is it regulation driven or is it just by a non-regulation organization driven. Sometimes they have quite diverging aspirations. And I think they're getting that global baseline. I think investors will benefit, impacted companies who actually report will benefit, and we will somewhere reach the point where you can really compare company A with company B, which hopefully also helps us to make better investment decisions in the future.
Thank you very much, Claudia. It's absolutely interesting to see how banks and asset owners have common challenges, namely data gathering and data quality and reporting, but also coping with an evolving regulation, but also some different angles. And I refer to the fact that banks have, of course, to deal with different kind of clients with different sizes and different availability of people to gather and communicate data, while instead asset owners focus more on the different asset classes. Thank you very much again, Claudia and Zabarki. Michael, back to you and back to academia, actually, because how can universities and academic researchers play supporting financial institutions to reach net zero and the work of alliances and networks such as the GFANZ? Is there any cooperation at the moment?
So I think in general terms, right, there are, as I think Daniel mentioned, right, I think there are corporations. I think you mentioned the University of Oxford, who has a climate center. I think there are currently no dedicated corporations with us, but I think one example for what academia can contribute to the discussion is maybe to participate in the organization and in the content of events like we're having right now. And I think Luxembourg is here a very active player in trying to sort of bridge, or bring research into the policymaking process and into the discussion also with stakeholders. I think in terms of the associations, of the relationship between alliances and academia, in general terms, the area of sustainable finance, I think, is well interrelated. So I think researchers are pretty engaged in the regulatory process to some extent, but also in the process of developing standards. I know more the PRI because they have an academic advisory board, also run regularly academic conferences, for example, where there is an exchange between stakeholders and academia. I think another aspect, of course, how academia can help in the transition is, with the obvious products that academia can produce, right, which is research on one hand, and then, of course, people on the other hand through our educational programs. Because something that I hear many times, I mean, Giuseppe and Claudia did not bring it up explicitly, but what I hear when I talk to stakeholders is that in this whole in this whole sphere of sustainable finance, coming, of course, a lot through the regulatory pressure, is of course the demand for educated people who can actually do the tasks and who are knowledgeable in the area of sustainable finance. not just, as Claudia put it, not just, of course, to fill in forms for the pure purpose of reporting, but of course to understand that there is, maybe hopefully investors will appreciate the reports and then make better investment decisions, but also to kind of support the entire process. So I think academia, I think there's always an educational challenge here, which links over to one of the buzzwords of today's world, which is interdisciplinarity. But I think sustainable finance is certainly one of those areas where interdisciplinarity is pretty obvious, and we don't have to search for it, because this intersection of the legal, regulatory side, the finance/economic side about what drives returns, asset prices, but also the environmental side, or you pick any other ESG topic, then you touch on sort of social aspects that where you need also expertise in terms of how to measure human rights violations or other kind of aspects. So I think in that context, I think research can and academia can contribute to the net zero transition, and to at least being part of the discussion and provide input that hopefully allows decision makers to make better decisions and also firms to adjust their strategies. I think obviously one topic that I think you already see it popping up in research, and I think it's going to just come up much more extensively in the next couple of months and years, is exactly the evaluation of the current rise of regulation, right? There are so many new regulatory frameworks coming into place, and at some point in time we need to start an evaluation of whether these regulations are helping or are not helping, and whether they're useful, and whether they sort of, there has to be some targets associated with the regulation, whether they are reached. Of course, it's tricky because these are also recent, that we don't yet have a long period exposed to actually see what happens. But the people have started working on it. We have projects at the university looking at SFDR. I've recently seen papers looking at climate stress tests at the bank level, and sort of what the consequences are of sort of processing this information, becoming aware of exposures that you might have, which you might have not known before. So I think in terms of, if I'm looking a few years out, then I think hopefully a contribution that academia can bring to the table and to this debate is to provide guidance on what kind of regulations are working well, and what kind of regulations are maybe costing more than they bring, or are maybe misdeveloped, misconceptualized, misdesigned, and need to be changed or updated. Thanks, Lorenzo.
Thank you very much, Michael. Thank you very much to you, Michael. So we have come to the last section of our webinar, the one in which our speakers will take your questions. We have some which have popped up. The first one, regarding net zero GHG emissions target for companies' own operational emissions. Which emission scope are you including in your net zero targets? Do you include scope 3 emissions?
Shall I start?
Giuseppe,
For banks, the important part on net zero target setting is on financed emissions. So it's by definition scope 3 for us, but it's also most of the times scope 3 also for our customers, because when I'm financing the oil and gas industry, for example, what produces basically 90% of the total emissions of the oil and gas industry is the usage of the oil and gas. It's not the extraction, where actually in the value chain, the weight of emissions is way lower than in the burning. So for each sector, I need to look at the value chain. I need to look at what the breakdown of emissions in the value chain to divide between scope 1, scope 2, and scope 3 emissions is. And normally we follow guidelines by Net Zero Banking Alliance, or by SBTI, or by PCAF, so the let's call them standard setters, in order to do our job and comply with those guidelines. We are not SBTI certified, because I'll be very honest, I don't see any value in doing that. For a banking portfolio, I'm not aware of big banks that today have their whole portfolio certified. What I can tell you is that when I'm setting targets to respect my commitment with Net Zero Banking Alliance, I set targets by following the SBTi guidelines and the PCAF guidelines. And my auditors need to certify that I do that. So I'm not directly SBTi certified, but I use the methodology.
Thanks a lot, Giuseppe. Claudia, do you want to add something on this?
Yes, maybe to add from my side for an asset owner, right? As Giuseppe mentioned, the finance emission or the scope 3 finance emissions is the largest part, so that is also valid for an asset owner, or at least for us. That means on one side we have on the underwriting side, right, the business, where we measure or started measuring our footprint. On the other side, on the asset or the investment side, right, we have covered quite a lot in our investment portfolio so far. And then there is Swiss Re as a company, right, where we have scope 1 and scope 2, which we measure. And then there are certain part of Swiss Re scope 3 emission in addition to the financed one, which we also measure, is this either, as an example, business travels, just to give you one example. When it comes to our investment portfolio, right, I already articulated beforehand that the data quality we get with regard to scope 3 emissions for our investment portfolios are not yet at the point which would satisfy the quality standard we are looking for to feel comfortable to release. So therefore, so far, scope 3 emissions not yet published. Nevertheless, of course, we monitor, we review. Yeah, that's for sure something we do.
Thank you very much, Claudia. So we have another question. How can financial institutions help their clients, both investors and investee companies, in their own transitions? Giuseppe.
Can you repeat me the question, please?
Yes, sorry. How can financial institutions help their clients, both investors and investee companies, in their own transitions?
Okay, so I'll take the angle of my clients. I certainly, as a bank, have a duty to accompany my clients in their transition. For the big clients, maybe it's not such a big challenge. If they are listed companies, they already know that they have, a big change ahead of them, and I don't need to explain what transition risk is, what physical risk is, and what the impacts on their business model and strategies can be. Okay, but if I have a small, medium enterprise, maybe they do not even know in some of the countries where we are, because they never thought about it, that they have such a big challenge ahead of them. So in that perspective, what we are doing in all of the countries where we are is also to set up a framework of training of our customers, giving them some tools to understand if they are exposed or not to climate risk, to transition risk, to physical risk, and being there with our team of sustainable finance advisory or ESG advisory that can help them if they need tapping markets, issuing green bonds, setting up their ESG strategy, or doing things like that. So what we must absolutely do is for the smaller and medium-sized companies to really lead the way and in some cases even explain to them the risks or the opportunities on the other side that they have, which are linked to the sector where they are, to the country where they are with all the specifics, because being in southern Italy or in northern Germany makes, of course, a big difference. And we have, no, you know, I was using the northest and the southest part of our geographical footprint in order to give you an idea of all the different shades that stay in between. In terms of our investors, I don't think we need to train them or have them. The thing that I see in that perspective is to give them all the information that they need. Okay, so that is my duty as I see it. I don't think I need to train an institutional investor on that. Of course, we still have a small percentage of our shares, as we are a public company, which is held by private investors. In that case, I think that regulation is already helping us, because they should need to give to their intermediary they're working with their sustainability preferences according to MiFID II and so on and so forth. So again, I think that my duty there as a listed company is to be transparent, to give all the information that regulation requires me to, and even something more, which is why we have our voluntary commitments. But, you know, as an investor, I think that Claudia can give us much more perspective into that.
Exactly,
Happy
Claudia.
to do so. Yeah, happy to do so. So maybe let me start with, there are several angles, right? And I think for us, one of the relevant ones is for sure the engagement framework we have developed. I mentioned that already several times. So to be more specific there, what is it actually? So we have an engagement framework for two topics. One is about data metrics, and the other one is about transition the business model of a specific company towards net zero. So that these are the items on which an investee company is engaged on. We are invested in. So for the two topics we have, underneath, we have 3 specific items we ask for, and we also make that public. So to be more concrete, when it comes to the transition to net zero, we ask our investee companies, it is about that we ask first developing a strategy, right? A climate strategy to actually transition. We ask that they should report the scope 1, scope 2 emissions they have in their business. And the last one I would need to cheat. But actually, so first is to measure the data, and second is to report the data. These are the 2 angles. In addition to that, we do not only tell them we do not only ask them for certain items, but we also refer to public frameworks. So where do they find further information? And afterwards, so on an annual basis, we collect back the information about where does a certain company stand with regard to being open to such an engagement. So in that way, we have the framework, which not only has asks, it also provides some helpful, hopefully helpful information to actually start with this ask. That's one angle. The second angle is then also that, just as I do here, we join public events, right, to talk about our approaches, to make them, to share them, and hopefully also answer questions in a meaningful way. But we also report in quite detailed about our approach. So is it in our sustainability report, our overarching responsible investing strategy, or is it dedicated to climate? There we use TCFD. But we also, as an example, join certain organizations to there be a sparring partner for further development. And we also offer that to our clients, right? When a client reaches out to us and says, hey, can we discuss that and that topic more? We would like to learn. That is another angle where we contribute or hopefully can help to spread the message and share knowledge.
Thanks a lot, Claudia. Well, it's 2 p.m. I think that we have run out of time. Before we conclude, I want to thank again our guests, Claudia, David, Giuseppe, and Michael, for sharing their work and insights, and as well as you all, our audience, for joining this webinar. Lastly, let me emphasize the importance of our collective efforts in this journey towards a sustainable future. By working together, sharing knowledge, and committing to ambitious goals, we can make a significant impact in mitigating climate change. I encourage you to visit our website, lsfi.lu, to subscribe to our newsletter and LinkedIn channel to get first-hand news on our activities and on everything related to sustainability. Thank you again and enjoy the rest of your day. Goodbye.